Good evening, everyone, and welcome. I'm Kathleen DeRose, the director of the Fubon Center for Technology, Business, and Innovation's Fintech Initiative. I'm thrilled to be here tonight with Dr. Andrew Ng, who epitomizes the mission of the Fubon Center to bring together academics and practitioners for meaningful conversations about finance and technology. Dr. Ng is a managing director with BlackRock's systematic investment team and the head of factors and sustainable solutions for BlackRock. He's a financial economist specializing in quantitative investing and a published author whose seminal book became the industry's factor investing Bible. Professor Ng is the winner of many industry prizes and grants. Before his tenure at BlackRock, Dr. Ng was a distinguished professor at Columbia University. On a personal note, Dr. Ng and I first met when our roles were reversed. I was running a quant hedge fund, and Andrew brought a group of university students to work on a project with us. It was great fun. For our audience, we will be taking questions at the end of the hour, so please put your question in the Q&A box at the bottom of your screen. And now I'm delighted to welcome you, Dr. Ng. We're so excited to have you here, and we're really looking forward to the conversation.
Thank you for having me. I'm excited too.
So first question, got to ask, you worked as both a professor and in industry, and you worked as a professor at a school that shall remain unnamed, but to the north of us in the city here. And we just want to hear a little bit more from you about when you were growing up and getting into finance. How did you start getting excited about investing and factors and everything else? We just love to hear a little bit about your history.
I was born in Malaysia. And in the 1960s and 1970s, Malaysia went through a series of pretty bad race riots. Bad enough such that Malaysia and Singapore used to be a united country, and then Singapore became independent. And like many migrants, my family searched for somewhere safe to bring up their kids. And right after the White Australia policy was lifted, and that was the official name of a Australian government policy, my family migrated to Perth, Australia. And I didn't really fit in. I was the only non-white kid in class for a very long time. I was just different. And my parents, both of them didn't go to university. My dad ran a corner store. We have to say bodega since we're in New York City. But although they didn't attend university, they really made sure that their children would. I just went all the way. But because I was different, I often asked why, and why things were a certain way. And that type of questioning led me eventually to do a PhD and then become a professor. I have to say I was given opportunities that were just unimagined, I think, if we had stayed in my country of birth. And then I, like many Americans, came here for education and then just stayed, and then married, and my kids are quintessential New Yorkers. But over this, I think, my career, what's been constant is this real question on why, why things are a certain way, why can we, how can we improve them? And that interplay between making some practical application and practical contribution together with really rigorous research, I think those are the two things that have really always excited me.
What I love about what you just said was you opened with sort of an amazing commercial for education. And I'm so glad that thread ran through your life and certainly produced like a ton of alpha actually on that education. So
well, now I'm like a Asian, Australian, American teacher, business leader, investor. I think I'm basically like you. I'm just like a New Yorker, just like everyone.
I'm flattered now. Thank you very much to be in that kind of company. But I think it's wonderful. You wear many hats and all of them successfully. So that's fantastic. I wonder if you could set the stage a little bit for the conversation we're going to have here about factor investing and the state of play today. And just by talking a little bit about some background trends in the wealth industry and especially about what's going on for retail investors, because the landscape, thanks to technology, has changed a lot in recent years. And we'd just love to hear from you who have a front seat at this change.
Well, I think contributions of Fubon here have been tremendous, and there's only going to be greater change in here. So it's really surprising because finance existed 100, 150 years ago, and finance will be with us, 100, 150 years time. But there's been a tremendous change in how individuals get their advice, and it's a huge market. So what we call US wealth, or the retail investment business in the United States, is $51 trillion. Right? It's just staggering. But what's amazing is that this market is growing at double digits per year. And there's been a lot of underlying change. The bulk of how Americans get their financial advice is usually through a financial advisor. And there are 280,000 financial advisors in the US. In fact, there's not enough of them. So for any undergrads here who are considering a career, I think there's great opportunities in financial advising or even in wholesaling of financial products. There's been huge amounts of consolidation. I think the PE industry, they have a very, very good nose for where the most profitable opportunities are. PE money has entered the space too. It's the most recent one, very large, has been Clayton with taking private a company called Focus Financial, that's Colony Group and Buckingham and a few other registered investment advisor networks, and that went private at $7 billion. So there's real money in motion. But what I think has been just really great is that we've got now these institutional quality products really made available for individuals. We're making now a lot of strides in customization, in telling a story that's accessible and intuitive to individuals. We're now making available private market investments, which really were just the only available to the largest, most sophisticated institutions not so long ago. And it's really democratizing all that access, but in a individual specific way so that we're aware of taxes, we get the liquidity, we're able to save for some of the most important problems of retirement, college education, really making a difference.
It's so great that part of that wonderful part of this industry is that we get to focus on outcomes for people. And as you said, the kind of flip side of margin pressure for the industry is lower costs for users, as you described. And this has made many products and services more scalable and accessible. And one of the kind of interesting trends that's still unfolding in this democratization is robo-advice and sort of all the other means by which individual investors could get access to really good products and advice for a much lower cost. And so I'm wondering, what do you think the state of robo-advice is today, and where are we going next?
Yeah, the robo-advice is really interesting because I said actually the bulk of where Americans get their financial advice is still across sitting from a financial advisor. And I think that's going to persist for some time. And the robo-advisors, the numbers are still really small. So some examples of players in here like Betterment, Wealthfront, Robinhood, these have approximately sub $100 billion. Now, that actually sounds very big, but if you take a wirehouse, these have assets of $5-6 trillion, and there are 4 major wirehouses, and then there are institutional broker-dealers and regional broker-dealers. I mean, these are in the the trillion. So you have $100 billion divided by 51 trillion for this entire market. It's still really small. Now, there's a couple of reasons for that. It's because it's usually always the younger generation who engages with technology, and those younger tech-savvy investors, they simply don't have many assets yet because they're in the younger stage of their life cycle. But the fintech space, all of these robo-advisors, these are even faster growth rates. We're talking already double digits for the industry. You multiply it by 2 or 3 for all of these. And what the technology really allows is exactly what you said. This ability to offer it at scale, at low cost. But technology allows us to be very personalized. Often these companies are pursuing mobile-first strategies there's a lot more choice that's being available for these individuals. It's that choice and the competition out there. It's really great for investors. Now, where I think the future is going with robos is I think it's probably not either or. You're not going to speak to a person and just use a robo, or you only speak to a person and you don't use a robot. I think actually the hybrid model is where it's going to land. And then this expansion of fintech, we really haven't yet. Okay, we can invest in a few asset classes and products, but fintech hasn't had really a lot of inroads yet into lending, into insurance, and still I think the comprehensive financial advice is still we're still scratching the surface. So it's what a tremendously exciting field that we're working in.
No, I think it's great, and the most popular product I think for American investors is the target date fund and the 401k account, and it's so fun to see that they're broadening out. And I love to talk to my students about retirement. I don't think they listen, but at least they can start early and let compound interest work for them. So let's turn to a little bit to factor investing, which is just sort of your wheelhouse, or more than that, really. You're the world's kind of one of the leading experts on factor investing. And I wonder if you could bring us up to speed from all the changes that have happened in factor investing and the understanding of factor investing since you wrote your book. And in particular, I'm just wondering if you think there's a consensus around what factors really drive returns, how that's evolved, and how people can get access to those factors, which of course has also evolved, continuing the conversation about technology making things more democratic and accessible. So let's turn to factors.
Yeah, so these are actually kind of not new. These date back actually to the 1930s. There's a seminal book by two accounting professors, Graham and Dodd, called Security Analysis, and they actually first lay out the first use of alternative data, which were financial statements, in the 1920s and 1930s, and the first systematic use of that. So they had a recipe for valuing a company. And we first see mention of what we call today a value factor and quality investing, dating way back to the early 20th century. So it's actually not new. These are very broad and persistent patterns of returns. They're very intuitive. You want to buy cheap or value. You like to search for trends, which are momentum strategies. You gravitate to safety with minimum volatility strategies. You search for companies with high quality earnings, and then you might prefer companies that are more nimble or smaller. These all have excess returns, positive excess returns in the long run. Now, they're not new at all. And I think one of the reasons why they've persisted for so long is that there's an economic rationale behind these. We can capture these premiums because it's exposed to risk. So if we can have a long enough horizon, we can ride out that risk and be compensated over the long run. Sometimes it's due to institutional types of impediments in the market. In the United States, we have a lot of public pension plans. These are a little bit, unfortunately, underfunded, but because of their underfunding, they tilt towards higher risk securities in an attempt to meet their high total return targets, and then they underweight the low volatility ones, and that gives rise to the excess returns and minimum volatility strategies. Or it's investor behavioral bias. I think investors have always gone with the crowd. We tend to exacerbate trends, and that gives rise to momentum investing. So these things will be with us for a long time. So what's happened over the last 2 decades is we've been able to now invest as individuals at scale in these types of strategies. So what used to be the province of these very large institutions before, and you had to have trading desks and talented researchers, you had to have all of this data, all this financial data, and some of the alternative data as well. You don't need that. You can buy an ETF, and you can also buy into that ETF and pay actually no pass-through taxes for the dividend income that comes about. And so these are absolutely terrific for individuals, and they're offered at very low cost. So I call this What's changed? It's actually that democratization of access that's really changed. Now, I should note that since the last 5, 6 years, in these style factor strategies, there was a drawdown that was quite severe in 2018 to 2020. Since that time, though, it's really been on an upswing. In fact, we went through the worst value drawdown ever recorded, right, in 100 years during 2018 to 2020. And the explanation there is that you had a lot of late cycle dynamics in 2018, 2019. But the thing that really sent it over the edge, and it was horrific, was COVID in 2020. So you have a lot of these value firms. They tend to have steady profits, but they're a little bit old-fashioned. You can think about they actually have physical capital in a factory, and when COVID comes, well, a lot of these firms with physical capital require physical interactions, and there just aren't any during that time. So it's not surprising that growth, especially technology that allows us to live in this virtual world, really took off. But the turnaround was very interesting, and it wasn't coincidence that the bottom of this value drawdown was in November 2020. And that was the time that Pfizer released its first vaccine, or rather, we had news that we had a first effective vaccine, and markets are forward-looking. We're still shut down now, right? But markets are forward-looking, so there is some pathway back to normalcy. And since markets are forward-looking, you see these value firms come back, and then value decisively beat growth in 21. 22 had a banner year when all the market was down by a third. But more recently, value has also pulled back. These other factors have done very well, momentum, quality especially. But the growth has benefited because of AI. And maybe we'll talk about AI and large language models later
sure.
on this call too.
We definitely have to get to that one for sure. So I love the way you connected the thread between Graham and Dodd and the concept of these kind of underlying fundamental economic drivers behind factors and what makes them so stable, because they are this return for risk and due to structural impediments and some behavioral biases in there. But I love the thread connecting Graham and Dodd to Fama and French, and then to your work. And you've addressed kind of their stability and endurance, despite the fact that Graham and Dodd was like
hundreds of years to come, I think. But they are cyclical as well. In fact,
yes.
Some of the cyclicality is precisely why you get rewarded unconditionally for these premiums over the long run.
So there was this paper that came out a couple of years ago called Factor Zoo, where people were kind of saying the writers were arguing about, are there too many factors and so forth. So is there a consensus? I think you advocate for 5. What are those 5? And how do you handle when people throw at you, hey, isn't this a factor? Like, isn't liquidity a factor? Isn't this a factor? What's your response to that?
Yeah, that's a really good question. And I think it's not so much in discovering the new factor per se. A lot of these things are already correlated with something being cheap or value, or it's correlated with a form of quality. In fact, a lot of the more recent sustainable and ESG signals are actually different forms of quality. And then you can estimate sentiment from social media, in real time, or you can estimate sentiment from general trends in prices over the last 6 to 9 months. But yes, they are different things, but overall they still measure sentiment, and so that's a momentum strategy. So it's actually fairly hard to get something that's truly new. If it's really truly new, it's actually alpha. And you should be prepared to pay up for alpha. If it's really alpha, then it requires a lot of skill, and there's a different type of access. We can't really offer these for the same broad audience. We can't do them at scale. A lot of alpha is ephemeral, temporary, and will quickly disappear if you do it in very large sizes. So that alpha, it is absolutely there. It's really hard to do it, but alpha are not these factors. The paper that you referred to by John Cochrane called the Factor Zoo. I think if you actually apply machine learning to very large amounts of firm characteristics, text data, all of the geolocation data that is related to company operations, you actually come up with these 5 factors. You come up with value, quality, momentum, some version of big companies and small companies, and then high volatility and low volatility, right? Which is the manifestation of the low volatility strategies. But what I think is very interesting is these studies like the factor zoo. It's not so much what these factors are. They're different. They're different ways of capturing the same thing. But there is now a difference between, I would say, proprietary versus generic factors. We have seen some differences in these returns. So if you do value, say, by patents or trademark, that tends to be a little bit more steady than doing value by book to market, which is the Farmer and French series of papers, or earning to price, which is also some variable normalized by a price signal. And so I think, all of these factors, they do tell us something a little bit about how proprietary or generic each of these things are. Moving on to kind of like, you might view these as refinements or even forms of nonlinearities. The other types of nonlinearities is we talked about value didn't do well over 2018 to 2020, really came back in 21 and 22. And then when ChatGPT was released, it's been a little bit more subdued. So there's cyclicality now, and that's another form of nonlinearity. It's nonlinearity over time, right? And that I think there really is evidence that these things can be timed, and potentially, if for the right investors, you might even time these factors as a source of return in your portfolio. Finally, I should come back to an earlier question that you asked about diversification over factors. It's please don't hold one factor. We should hold a diverse mixture of them.
No, I mean that was just a great answer and covered so much waterfront, whether it was regime shifting among factors or new sources of data that can be mined to refine them and capture interesting things about how they behave. Just a super interesting set of insights that you just shared. I'm wondering if we could come back to actually how you package and actually get access to these investment strategies. And there's been a lot of change in that, also kind of in the flavor of technology-driven and scalable democratization. And so we're talking about direct indexing and ETFs and what you can buy on Robinhood. And I wonder if we could just go there a little bit so that we can update folks in our audience about some of these available ways to invest that are new.
Yeah, so that's a great thing. So maybe I should say, once upon a time, there was the mutual fund, which was formed in 1940 under the Investment Act. And they dominated in the 1980s and 1990s. So this is the time of Peter Lynch and Magellan. And that really changed things because for the first time, you didn't have to hold individual stocks and pay individual fees, right, to the broker for each of these individual stock positions. You could just hold a mutual fund, right? And so that was game changing then. Now, index ETFs really started in the 2000s, and that was one of the reasons why BlackRock purchased BGI, this Barclays Global Investors, during the financial crisis. What was new about the ETF, particularly for individuals, was that they had some tax advantages. So if you buy a mutual fund, you will have to pay taxes on the capital gains that the investment manager buys and sells those stocks inside that mutual fund. What's game changing about the ETFs, and originally they were all tracking indices, things like the S&P 500 or the Russell 2000. So you could get broad market exposure, but you didn't have to actually pay tax on the stocks that had turned over in those portfolios. And those are huge advantages to to an individual. Now, the reason why the ETF is able to have no tax pass-through compared to the mutual fund was originally called, you get these exemptions. In particular, these you got in-kind treatment for stocks coming in and out for that fund. This is a little technical, in what's called the redemption creation process, but it's how new ETF shares get issued when the funds are actually growing. So index ETFs beat mutual funds, and I would advise that pretty much for an everyday mom and dad, you should not be holding the mutual fund. Please hold the ETF. Your tax bill will be a lot lower. Now, what has transpired more recently is that this exemption, this in-kind treatment of capital gains inside that ETF can be broadened out. And this was called the ETF rule in 2019. And so now we see a lot of active ETFs. You don't have to be an index ETF anymore. So you can put dynamic factor rotation strategies in there. And that's our big seller this year. It's got $13 billion in for this dynamic factor rotation active ETF. And now you're able to get that same tax advantage treatment, but now for any type of active strategy, not just the index ones. Now, the game changer that's only beginning today is exactly what you said, Kathleen, direct indexing. So, what is that? So direct indexing is a little bit of a misnomer. You don't really have to track an index for this, but the direct is accurate in the sense that you hold individual stocks yourself in a separately managed account, right? So you don't buy a fund, you don't buy an ETF, you don't buy a mutual fund. So these are stocks that you hold directly in your account, and they could track an index, like give me S&P 500 exposure, or they could meet some other outcome, like give me income, right, or a dividend stream. But you're doing this directly holding individual stocks. Now, as an individual, it's probably the case that you can't trade 500 stocks, or I can't, but maybe some in our audience could, directly to track the S&P 500. So what you do is you hand over the management of your account, but you own that account. It's still yours. You hand over the management of that account to an asset manager, but it's still yours. You're not buying a fund. You're still holding these individual stocks. Now, what's especially interesting about this direct indexing or these separately managed account SMAs is just as the ETF beat the mutual fund on taxes, the direct index SMA beats the ETF. Okay, and well, how can you say that? Like, the ETF, you don't actually pay any tax pass-through. It's zero. Well, it's even better in the direct indexing because actually what you do is you can sell your tax losses. So the stocks that have losses in your portfolio, you sell them, and those tax losses can be used to offset gains somewhere else in your portfolio. So actually, the taxes are negative, or put another way, by holding the SMA and selling the losses, the stocks that have experienced losses in that SMA, you are able to generate those losses and then offset them with gains somewhere else. Now, you can't maybe use all of those losses in one tax year. You can carry them over. There is a $3,000 limit, but you can carry them over indefinitely until you have some capital gains in your portfolio. So this is just actually beginning right now. The biggest player here is Parametric, but it's going to be over the next 2 decades. I think it's even going to have steeper growth rates than ETFs. Now, tax is one advantage, but because you own those assets yourself, everything that we talked about earlier, Kathleen, on customization and personalization, you can put your preferences in there. You might not want to hold some particular stocks for religious reasons. You have a preference for, say, greener stocks because you might be climate conscious. You can put those in because it's your account. And you can put all of those directives in, and the asset manager can do them at your account level. And so this personalization, this customization I think with the advantages of the tax loss harvesting, it's really game changing, and we're just beginning to see that.
That's so cool. That was a quick tour through some of the sort of the packaging and wrapping around fundamental investment strategies that's occurred. I was wondering actually if we could turn to kind of a hot topic, and I got to preface this with the disclaimer, not investment advice, right? Because you wrote a really cool paper asking the question and answering it. Should you add Bitcoin to your portfolio? And I think you relied on data that went up to 2021, which was before the FTX blow up, but also before the recent election rally. And you had some really interesting analysis. And so I think it'd be worth sharing with folks, how you approached answering that question, which was very, very quantitative and very, very useful, and to share some of the insights from that paper. I think people would find it interesting.
Yeah, it's the paper's called Asset Allocation with Crypto, and then the subtitle is Applications of Preferences for Positive Skewness. And we can give you a link to the paper later if you'd like to request that. Now, just going back to this is not financial advice. So I think for the average person, the average mom and dad, don't hold crypto. You're better off with plain vanilla stocks and bonds, rebalance, minimize costs. But there are some instances that I think crypto does some interesting things for your portfolio. Now, one of the unique elements about crypto is positive skewness, and this positive skewness is unique because most assets crash, like real estate crashes. High yield bonds crash. FX carry strategies often done by hedge funds, they crash. Equities crash most recently in 2022, right? And so when we say that this is a positive skewness, what actually we mean by this is that instead of melting down, there is a small probability that Bitcoin can melt up. And there's a really nice quote by Thomas Peterffy. He's the 65th richest man in the world. And he says, I think it can go to zero, and I think it can go to $1 million. I have no idea. And what's applied to crypto, most of the time, you actually might lose money on this. But there is a regime, let's call it bliss. There is a bliss regime where that right-hand skew takes off, and you can be very wealthy. It's almost like buying a lottery ticket. In fact, the odds of you winning the lottery are probably smaller than I think this low probability of it about going to bliss. Now, when I said this is unique, usually to avoid crashes, you hold less equity, right? To avoid real estate implosions, you hold less real estate. But if you have positive skewness now, then actually the reasoning works in the opposite way. It might pay to hold a really small amount of crypto, maybe just 1 to 3% of your portfolio, just in case the bliss event happens and you want to be exposed to that. And so the paper goes through some utility calculations, but the main intuition is Thomas Peterffy's quote. I think it can go to zero. I think it can go to $1 million. I have no idea. But if it does go to $1 million, that's that right-hand skewness, and you might want a little bit of exposure in your portfolio.
I just like this one because it's a disciplined answer to that question. So I hope people find it useful. I know I did. I'm wondering if we could expand upon this theme a little bit, and that the other kind of trend is to bring things like alternatives actually in general to retail investors who historically didn't have access to them because of constraints, because you had to be accredited investor or cost or access in general. Are we going to be tokenizing everything and making alternatives, PE hedge funds, real estate accessible to retail investors, do you think, anytime soon?
Yeah, people are really, really trying that. And so we've had what are called interval funds, which give periodic liquidity, usually every quarter or so. But the liquidity is limited. And so you might have only 5% of the fund being made available to pay out, but there's actually 15 or 20% of the fund that actually has a liquidation request. You're capped at 5. And there are some number of examples of these funds in real estate that actually have had these sorts of gates. So interval funds are already with us. They tend to be for accredited or qualified investors, as you say. I think the access to, like say through an ETF for these private market strategies, people are really trying now. Nothing yet has had SEC approval, but that will be a really big thing. Even having that interval fund for availability for US wealth, and we'll see a lot more interval funds as well. Even that is a great development so that we can actually have access to these private market strategies, just as these large institutions have done that.
And so you're not concerned too much about potential like liquidity mismatch there or other things like that.
Well, let's see if the SEC approves them. Yeah. But any 40 Act fund, this is a little bit technical and a law answer, but any 40 Act fund does have a limit on the amount of illiquid assets that fund can hold, and it's a really low limit.
Yeah, exactly. So that's the first thing on the horizon, as opposed to tokenizing everything.
Yeah, tokenizing also is here as well, but I mean, tokenizing I view as a much smarter, more efficient accounting ledger for transferring ownership. It doesn't solve the problem. You can be tokenized, great, right? That's like another accounting book of record or another investment book of record, but you haven't solved this problem of how you act on vehicle that someone can actually buy.
Yeah, no, that's I think that makes total sense. I'm wondering if we could also talk a little bit about ESG. So one of the words in your title is actually sustainability, and it's a term that has, for good or for worse, taken on different meanings recently. And so I'm wondering if you could just share with us what your thoughts are there. How do you connect it back to some of the fundamental factor investing thinking that you support, and how do those two relate to each other? And where are we with sustainability and investing?
Yeah, I think ESG, you're absolutely right. It's a term people don't like to use right now, but I think a lot of the backlash against it is because we really haven't treated this as an industry or in society as a positive alpha driver, right? And it's not all, in fact, only a very small minority of ESG data or sustainable data can lead to high returns. But if you were able to use the sustainable and ESG data just as we would regular financial data, but what we're going to do with it is we're going to try to predict returns. We're going to incrementally improve the returns of your portfolio. I think that's a very different very different viewpoint for, I think, the application of sustainability and ESG. So we call this the double bottom line. It has to have a financial outcome. That is, can we predict returns and make our portfolios better off? But it also might correspond to some real world social outcomes that we care about. And that's the second bottom line. But I think we should be approaching this from an alpha perspective, from how we can use it to generate excess returns. And I think a lot of the backlash has just been because it's treated as being unrelated to a financial outcome. I'm really interested in those things that have this double bottom line. We can both make investors better off, and potentially we can speak to some real world social outcomes. Now, I can say that there's a lot of stuff that just is irrelevant and doesn't satisfy the double bottom line. So one of those is ESG ratings. There's really, in fact, there's a negative relation in some of our research. They really have probably as much predictive power as the regular, AAA rating did for some highly complex derivative security in the financial crisis in 2008. It's just a label. Right. Yeah. And I think also most ESG is done by exclusions, right? So we throw out a sector, we like coal and gas, or we exclude a bunch of companies on some ESG criteria. And if you're doing exclusions, right, you're throwing information or opportunities away. Like there's a mathematical result that if you throw things away, you shrink your information or your opportunity set, you can only do worse, right? By doing that, right? And so it's really unfortunate because this is the way that most sustainable investing is done. Is through throwing stuff out. Is through exclusions and divestments. So maybe I'll just give you two examples of alpha signals. One example is corporate culture. And corporate culture was one of the best performing signals we talked about COVID and value doing really badly in 2020. It was one of the best return drivers in 2020 and in 2021. And I think we all want to work in a place that has, good corporate culture. And what we found is this is sometimes a little bit hard to measure, but you can use natural language processing on text. You can do it on conference calls. You can do it on text that the company has produced. You can do it on broker reports. And then you can extract a measure of corporate culture using these natural language processing techniques. It's actually correlated with financial quality or steadiness of earnings, the types of earnings, and so we actually put it side by side with some earnings-based signals for quality. It's really a non-financial measure of quality, and it speaks to, I think, if you've got good corporate culture, there's probably some element of governance that's behind it, and probably some social aspect, at least for that company, right? There is a social outcome there. Another example is veterans hiring. Veterans, they get short shrift as a measure of diversity. But on my team, we have a captain of the U.S. Army. There's a captain of the British Army, Navy veteran, some other armed forces veterans, and I think they don't really get counted in diversity because a lot of veterans are male, and a lot of those male veterans are white. But these people have just completely different experiences for me. Some of them, served in the Middle East in combat, and well, frankly, actually, I don't want to have, some experiences like that. But these are dynamic. They're very loyal, hardworking. They're flexible. They're independent, and by any measure, they contribute to diversity. Because they don't have the same experiences you and me do. Now, the financial outcome is actually that companies with more veterans actually do actually have higher returns. Now, this is especially true. It's not limited to, but it's especially true for the defense sector. And there's a direct correlation with the number of veterans that some of these defense companies have. You have to adjust for size, and the number of government contracts that they get awarded, right? And so you get more government contracts, that's higher revenue. Your company is likely to have higher returns. But it actually also turns out for other industries as well. And finance, particularly insurance, is one of the industries that tends to hire a lot of veterans. Now, the other aspect of the double bottom line here, I think, is really relevant because often upon leaving the service, these veterans are on the lower left-hand tails of income and of wealth, right? And having a job just, it's just really helpful for reintegration to society. You can formally show that areas in the country with higher levels of veteran employment have lower levels of health expenditure tabulated by the Department of Veterans Affairs. So, this is an example of the double bottom line. You can predict returns, right? And you can actually at least measure or contribute to some real world financial outcomes, social outcomes. But we are interested in
I love this insight.
Alpha.
Yeah, alpha. But I love that you've quantified some things that are hard to quantify. And then it's just a great story about how fun finance is, that you kind of can unearth these cool nuggets that have really great social insights. So we saved a hot topic for last before we get to the questions. And I do want to leave time for that. But look, everybody's talking about AI. Everybody's incorporating it into business processes and, of course, investment processes. And I'm wondering, what you're seeing out there, what's a fad, what's actually going to take hold. It's pretty adjacent to some statistical techniques in some ways, but there's also completely novel things you can do. So what do you think about this, and where do you think it's going?
Yeah, I've really changed my workflow for ChatGPT. I use it all the time now. I try not to write code, but still I do. And Copilot on GitHub is a far better programmer coder than I ever will be. And it's changed my life because you can, even just writing the comments, it will actually magically produce code for you. You can translate code from one language to another. It's awesome. But yeah, I think we're still searching for the killer app still. But I'll just give some examples for how I just used it over the past couple of days. So I had to write a reference letter for someone, and that would have taken a couple of hours. I asked the person to submit their statement to go to graduate school, along with a CV transcript, fed it into ChatGPT, and voila, 1 minute later, you actually have a pretty good draft that you can actually refine. So what used to take me 4 hours, it took 15 minutes, even less than 15 minutes. My older daughter is starting to look at colleges, and I was exploring some of these about ask ChatGPT for an itinerary, and it can give you a table of universities in some geographic location like Northeast, along with days when they have tours, how long you have to book ahead for these, and then even maybe give a itinerary of how to minimize distance. I was impressed with it so much that I'm using ChatGPT to plan our Italy vacation for spring break. And it gives a list of hotels and a price range and a particular neighborhood of Rome. I use it now. I'm trying to use it now everywhere I can. Hallucination is a problem, so yes, you do have to distrust everything, but it's here to stay. So maybe I'll just give some examples in investing about how to use it. And these are still very early for us, but everyone like us, I think we're all just searching and doing the best that we can. Okay, so we used to estimate things like corporate culture from natural language processing. But now you can estimate sentiment, you can estimate corporate culture, you can estimate deception or lying. You can estimate a whole bunch of these tones or different aspects of sentiments from text documents. And you can just ask ChatGPT to do this. It will even process numeric data, but it's, I think, very good with text. It's not so great with numbers. So estimating any type of and summarizing information from text. So we have some sentiment signals using ChatGPT. We are creating thematic baskets of stocks. So Trump just got elected, and so you might think about various baskets that would benefit from the so-called Trump trade. But I think it goes beyond that. You can ask ChatGPT to help create thematic baskets for these class of Ozempic drugs. That goes beyond the biotech companies to food manufacturers and clothing providers, retailers, right? Anything associated with the consequences of people losing weights. Now, in this, I want to give a little bit of a detail, because it's a very good example of some of the successes and failures of these large language models. Okay, so now almost by definition, larger companies produce more information, and information is what's used to train these large language models. So you could ask ChatGPT to produce a list of stocks for you. But if you do that, you're going to get a list that's biased towards large companies, because large companies produce more data, and there's more data for those companies that's in the training sample. Now, that could be fine. You might be actually having a large cap portfolio, but usually you have several thousand stocks around if you're looking at a global mandate, and tens of thousands of securities. if you're, or actually tens of thousands of issuers if you're doing a fixed income portfolio. So you kind of need to get information on small stuff as well. So instead of actually asking ChatGPT for a list of stocks or firms, what we actually ask ChatGPT for is business models, right? So business models are clienteles, who your suppliers are, who your clients are, the types of products this company is doing, right? The geographies where the company is operating, the target customers in terms of demographics, right? All of this is a type of business model. So you have a topic, you ask it for a business model that might fare well or poorly, right, given that topic. Now, you actually haven't touched the actual company names, but you have a description. You can take that description of the business model, and then you can see how it matches that with the actual descriptions of companies, but you use a different procedure for that. And so companies will describe themselves. There's a lot of information in regulatory filings. Any 10K has a description of the company's businesses. Brokers, analysts will describe what the company does as well. So you can find the minimum distance between the business model produced by the large language model and the list of descriptions in some other data. Now, notice by doing this, we have circumvented this small size bias, or rather the bias towards ChatGPT just giving you large companies. Right? And so that's, I think, a good example that you have to be careful in doing these, but the things that they open up are amazing. Another example is you can now do any type of language you want. So we used to spend all this time and making very specialized models, and I think you still do need to for, say, Chinese or Korean. But now you can have Thai, right, or Bahasa Malay, or well, I was going to say Nordics, but most company information in the Nordics is actually in English. But now you don't actually need these specialized models. You can actually get ChatGPT to do all the translations for you.
As you can imagine, we're getting multiple questions on the AI front. So maybe just to pick up on a couple of them from the audience. So firstly, are you using the enterprise license ChatGPT or using it at home? And then have you compared some of the different models like Claude or other things for different tasks? So do you have a viewpoint on that you could share with the audience?
Yeah, so our strategy, like many corporations, you have to have an enterprise strategy, and you have to have very well-defined demarcations about what data can be used into the large language model. And so we're with Microsoft Copilot, and we have a walled garden. And I find that far less effective than the ChatGPT that's on my personal machine. And I may or may not be using my personal machine for some of these more business related tasks.
Got it. And then go ahead.
Yeah, I think it's hard not to anthropomorphize these things. Personally, I find ChatGPT, which is GTP 4.0, rather condescending. You ask it to do some stuff, and it's got this big disclaimer about that it's not designed to do this, thing. I find Claude quite personable, but the one I really like is Mistral. But Mistral takes some technical expertise to use. But Mistral you can install locally. It has this insane window length. You can mention my book, which is like 800 pages, and you can put the entire book into the prompt. Right? It's like, it's just amazing, and you can run it locally. But they are really quite different. But if you had to pick one, I would probably go with GPT-4.
Yeah. Then we have one other question about AI, and it has to really do with something you said earlier on in our conversation about the ongoing need for financial advice. We have lots of products, but a shortage of advisors. And the question really relates to, could we start to actually automate some good advice for folks with their, increasingly human-like thinking? Is this going to change the role of financial analysts or disintermediate them? What do you think about that?
I think it's going to augment them. All right, it's really going to scale advisor practices. And there's a lot of stuff right now that's, let's call it, in the trenches, kind of more boring but absolutely essential work, like gauging risk profiles and forming an
Yes.
investment policy statement, right? Forming individual commentary about the funds or the stocks that these individuals hold, right? And that's probably less interesting, definitely less commercially relevant than finding new prospects for a financial advisor business, or encouraging your clients to invest in some new products. So this is tailor-made, I think, for large language models, gauging risk profiles, writing commentary, summarizing information. I think it can be really, really empowering for financial advisors. And I think the ability, we haven't seen it yet, but you're going to be able to get on-demand commentary from an AI assistant on your phone, for a particular fund or portfolio that you hold.
Should we think hard about shaping behavior in this way, or do we think this is net a good thing?
Oh, that's a very interesting question. So there's a great paper by Wei Jiang, who's at Emory University, and it's called "How to Talk When a Machine is Listening." And so this is actually pre-ChatGPT, but I would say that everything in the paper has just been magnified in the effects. And so they document that the language used by corporate officers on a conference call has changed because, well, machines are now listening and processing their statements. There's probably a bit more independent and therefore material information in the Q&A parts of the conference call. But yeah, managers have started to speak differently because of these large language models. It's already happening.
Yeah. I think that's almost a great note to end on, because it sort of opens up that wide new world of the future of investing that you did a great job explaining today. And also, I just want to thank you for being here with us. It was an amazing conversation, from the tour back to Graham and Dodd to the latest thinking about how to incorporate AI and investing. You've been an absolutely fabulous guest, and thank you so much for just a fantastic chat. And also thanks to our audience for supporting the Fubon Center and everything we do here at NYU to support our students and faculty and alumni, and to have wonderful events like this sponsored by the Fubon Center. So we're really grateful to have had you as a guest. It was just so much fun to hang out with you here tonight, and I know our audience really loved it. Thank you so much.
Thank you for having me.